Earnings season is continuing to heat up, with Microsoft and Meta both reporting their earnings today. So far, the reaction to these two companies' earnings reports hasn't been nearly as dramatic as Google's. Microsoft is only up 0.7% at the time of recording this, and Meta is actually down 0.9%. So in this video, we are going to discuss Microsoft's earnings, and I will discuss Meta's in a future video. I think Microsoft's are much more interesting because the business had a stellar report, yet the stock isn't moving much, and I want to do my best to explain why. I will also be sharing my opinions on whether I think the stock is looking cheap or expensive today. So with that being said, let's hop right into the video. So as always, I went through Microsoft's earnings report and I found all of the key highlights that I think investors need to know, and I took screenshots of them. So let's hop into the Daniel Pronk slideshow for today. So right away, we can see that Microsoft's revenue came in at $65.6 billion, which is up 16% year over year, which is a pretty strong growth rate to the revenue on such a massive company. Operating income came in at $30.6 billion, which is up 14% year over year, and net income came in at $24.7 billion, which is up 11% year over year. Then we have a quote from the management which says, "Strong execution by our sales teams and partners delivered a solid start to our fiscal year with Microsoft Cloud revenue of $38.9 billion, up 22% year over year." So Microsoft Cloud is continuing to grow very strong at over 20% on a yearly basis. Then we have the business highlights, which says, revenue in the productivity and business processes was $28.3 billion, up 12% year over year. Microsoft 365 commercial products and cloud services revenue increased 13%. Microsoft 365 consumer products and cloud services revenue increased 5%. LinkedIn revenue increased 10%. Dynamic products and cloud services revenue increased 14%. Revenue in Intelligent Cloud was $24.1 billion, an increase of 20%. Servers, products, and cloud services revenue increased 23%, driven by Azure and other cloud services revenue growth of 33%. So Microsoft's Intelligent Cloud business segment as a whole increased by 20%, but it looks like Azure and other cloud services are continuing to grow very strong at 33% year over year, which is just insane. Windows OEM and devices revenue increased 2%, Xbox content and services revenue increased 61%, but 53% of that was from the impact of the Activision acquisition, which is interesting to say, but Xbox content in general is still growing on an organic basis as well. Search and news advertising revenue, excluding traffic acquisition costs, increased by 18%, which is interesting because Microsoft has been doing this whole Bing push recently, and they're really trying to attack Google's moat, and it seems like their search revenue is actually growing pretty strong. So that may be something to watch out for as well. And it doesn't look like Microsoft is actually successfully attacking Google's moat because Google just had an incredible earnings report, but still, this is something to watch out and pay attention to. Now, this next screenshot is simply just a table of all of the numbers that I just covered in the previous screenshot. So if you want to pause the video and actually take a look at all of the different business segments of Microsoft and all of their growth rates, then please feel free to pause the video right now. And yeah, we're going to move on though. All right, so now we're getting into the cash flow statement, which is my favorite financial statement to take a look at. So the first thing that we can see here is that Microsoft's stock-based compensation came in at $2.8 billion on the quarter, which is up from $2.5 billion last year for the same quarter. So stock-based compensation is growing. However, we can also see that Microsoft's operating cash flow came in at $34.2 billion, which is an increase of 12% year over year from the $30.6 billion they produced last year. So the operating profits of this business are continuing to grow. And what I also like about Microsoft is their stock-based compensation is quite low relative to the operating profits the business generates. This is not the same over at Google. Google has a lot of stock-based compensation going on. In fact, I believe it's actually double Microsoft's, and they're producing less operating cash flow. So that is something to note, is that Microsoft actually doesn't do nearly as much stock-based compensation. Now down here, we can see that Microsoft also repurchased $4.1 billion worth of shares on the quarter and paid a dividend of about $5.6 billion. Now their cash flow statement was quite long, so I scrolled down and took another screenshot. And the new information in this screenshot is that Microsoft did spend roughly $15 billion on capital expenditures in this quarter, which is an increase of 50% year over year from the roughly $10 billion they spent on CapEx last year. And due to this massive increase in capital expenditures, Microsoft's free cash flow actually declined by about 7% year over year even though their operating cash flow grew by 12%. So the capital expenditures are actually causing free cash flow to decline on a year-over-year basis. This next screenshot comes from Microsoft's earnings presentation, and I want to focus on the cash flow right here. So this says, cash flow from operations was 34.2 billion, up 12% year over year, driven by strong cloud billings and collections, partially offset by higher supplier, employee, and tax payments. Free cash flow was 19.3 billion, down 7% year over year, reflecting higher capital expenditures to support cloud and AI offerings. So Microsoft is spending a lot more money on growing their AI and cloud offerings, and that is where the majority of the increased capital expenditures is actually going. Now, the last screenshot that I have here is Microsoft's cloud revenue on a quarterly basis since December of 2019. And we can see that Microsoft's cloud revenue has actually more than tripled since December of 2019, and it just set in a fresh all-time high, and it looks like it is continuing to grow very strong. On an annualized basis, Microsoft Cloud is almost doing $120 billion in revenue now. That is just crazy. And we're going to have to see what Amazon reports tomorrow, because Google just reported 35% year-over-year growth to Google Cloud revenue. Azure was 33%. So these two companies are now growing their cloud divisions at 30% plus on a year-over-year basis. So we're going to have to see if Amazon's cloud is also accelerating and matching these companies' growth. I personally do not think that AWS is going to post 30% growth rates, but maybe it will be in the 20%, and we're going to have to see how that all plays out. But yeah, that is the Daniel Pronk slideshow for Microsoft's earnings this quarter. So let's now talk about Microsoft's valuation. And I did all of the calculations manually for the trailing 12 months operating cash flow, which came in at 122.2 billion. And in the trailing 12 months, Microsoft has now also done 72.4 billion in free cash flow. Now, since Microsoft is investing so much money into capital expenditures and growing the business, growing the AI, growing the cloud, I do think that there is a strong argument that operating cash flow is the metric that investors should be focusing on right now. And therefore, the price to operating cash flow ratio may be the best metric to value Microsoft's business today. So Microsoft's market cap is $3.21 trillion today. And as I said, they did $122.2 billion in operating cash flow in the trailing 12 months now, which means the business is trading for a price to operating cash flow of 26.26. So this is the metric I'm going to care most about. However, I am interested to know the price to free cash flow of Microsoft today, which is now 44.33, which is very, very high. So next, what I want to do is head over to Stock Unlock's freeform tool, and I want to take a look at Microsoft's long-term historical average price to operating cash flow ratio. And right here, over the past decade, we can see that the stock has traded for an average price to operating cash flow of 20. So Microsoft trading for a 26 price to operating cash flow today does tell us that it is trading 30% above its historical averages, which could also make a strong argument that Microsoft stock is not looking cheap today, and it actually is selling for a pretty steep premium. Now, if we also take a look at its price to free cash flow over the past decade, the average was about 27.7. And again, it is trading for 44 today. So Microsoft on a price to free cash flow basis is trading for a significant premium. And a business trading for a 44 price to free cash flow and growing its revenue at 16%, in my opinion, is a very expensive stock. Like, I know Microsoft is a very high quality business. I know it's almost guaranteed to continue growing in the future, but the price that investors are paying for this future growth is extremely high. And therefore, I am not really interested in the stock today. I have been saying that I do think it is very expensive, and those are the reasons why. Now, another very interesting thing is if we actually zoom out to 1999, we can see that the highest Microsoft's price to free cash flow got was 52. And again, today it is now trading for about 44. So Microsoft's price to free cash flow ratios are actually approaching the levels that it was trading for during the tech bubble. In fact, in the year 2000, Microsoft was trading for a lower price to free cash flow than it is today. And it was a much smaller business back then. It wasn't a $3.2 trillion company. However, as I said earlier, Microsoft is investing a lot of money into capital expenditures, so the price to operating cash flow is probably a better metric right now, and it is trading for about 26. And if we take a look in the year of 1999, it was trading for about 50 times operating cash flow. So it doesn't look like it is nearly as expensive on an operating cash flow basis as it was during the tech bubble, but even here in 2001, Microsoft was trading for about a 26 price to free cash flow, or price to operating cash flow. So what I want to do now is explain the risk of buying stocks at extremely high price ratios, which I do believe Microsoft is trading for today. And to help explain this, we're going to go back to the 2009 Berkshire letter to shareholders that Warren Buffett actually wrote. And by the way, over the past month or so, I have been reading through all of Berkshire's annual shareholder letters, and they are an absolute masterclass on investing. And I have been making a very long PDF document on all of the notes and everything that I find that I think is worth noting down and all the highlights from every report. And I'm putting that into a Google document that I will be sharing with my Patreon members. Then I am going to be going through this document on an annual basis, going through every single letter, all of the key investing tips and takeaways, and making videos for my Patreon members. So if you are interested in getting access to this document and all of the additional content that I will be making, going through all of the investment tips, then consider joining my Patreon, and you will also get a lot of other videos, benefits, my personal portfolio, access to my Discord community, access to all of my buys and sells, and much more. For only $10 a month, you can get all of this extra content from me and track my portfolio. So it's a steal. People have been loving the Patreon, so I would strongly recommend checking it out if you like my channel, you want to support my channel, and if you want to get more content from me. But with that being said, let's now talk about the highlighted comment here from Warren Buffett in 2009, where he wrote, "A more difficult decision for us was how to measure the progress of Berkshire versus the S&P. There are good arguments for simply using the change in our stock price over an extended period of time. In fact, that is the best test. But year-to-year market prices can be extraordinarily erratic. Even evaluations covering as long as a decade can be greatly distorted by foolishly high or low prices at the beginning or end of the measurement period. Steve Ballmer of Microsoft or Jeff Emmett of GE can tell you about that problem, suffering as they do from the nosebleed prices at which their stocks traded when they were handed the managerial baton." So basically what Warren Buffett is saying here is that even over a decade period, your share price or the share price of a business can underperform the fundamentals of the business if the starting point was an extremely high price. And he points out how this was happening to Microsoft in 2009. So what we can actually do is head over to Microsoft here, and let's go to 2000 or really 1999, where the share price peaked right about here-ish. And let's grab that top point, and then let's go to February of 2009 when Warren Buffett wrote that shareholder letter, which was right around here. So we can clearly see that Microsoft's share price fell by 67% from the peak of the tech bubble to February of 2009. This is a massive drop to Microsoft's share price. But what's funny is if we go over to Microsoft's financials and we go over to its revenue from 1999 right here to about 2009 when that letter to shareholders was written, then we can see that Microsoft grew its revenue from $21 billion to $61.2 billion in 2009. So Microsoft quite literally tripled its revenue from 1999 to 2009, yet the share price fell by 67%. Now, if we also take a look at Microsoft's operating cash flows from that period, we can see that they did $12 billion in operating cash flow in 1999. And by 2009, operating cash flow basically doubled to $22 billion. So Microsoft's fundamentals grew extremely well and rapidly from 1999 to 2009. But the share price fell 67% because the stock was simply so overvalued and expensive in 1999. And the multiple compression that happened over the next decade completely offset all of the fundamental growth to Microsoft's business. And I actually have a chart right here that does explain this. So in this chart and in the table, we are tracking Microsoft's price to operating cash flow, stock price, and operating cash flow growth from 2000 to 2009. And we can see that the overall operating cash flow compounded at 7% annually. However, the price to operating cash flow declined by 11.3% annually, which ultimately resulted in the share price falling by 5% annually, again, despite the underlying fundamental growth of the business. This is exactly what Warren Buffett was talking about when he was saying that it's a risk to pay extremely high prices for a business because high prices can offset underlying fundamental growth. And I do think that Microsoft is getting to a point right now where its price multiples are getting to that very high point. And it is pricing in a lot of future growth. And if the multiples do end up contracting in the future, then that contraction of price multiple could offset underlying fundamental growth to the business and ultimately result in the share price not doing much or maybe even producing negative returns over the next 5 to 10 years. So to wrap up this video and to wrap up my rant right here, let's project out Microsoft's operating cash flow over the next 5 years. Say it will grow at a 12% compounded annual growth rate. The company's going to continue buying back shares. The dividend will grow in line with profits. and Microsoft will trade for its historical average price to operating cash flow multiple of 20. Now, when we input these metrics right here, we get a compounded annual growth rate to the share price of about 7% annually. And again, this is with 12% operating profit growth annually over the next 5 years. In fact, if we scroll down, this would mean that Microsoft would be producing about $209 billion in operating cash flow by the year of 2029, which is essentially doubling the company's operating profits over the next 5 years. And even if Microsoft does this, the share price could underperform the market over the next 5 years, simply due to the high price that it is selling for in the market today. And this is why I personally am not interested in Microsoft stock today. I do think that it is a phenomenal business. I think it's a great business. I think it's going to grow in the future. I think that's almost guaranteed. But the price and the business are two different things. And I think that the stock price today is already factoring in a lot of Microsoft's business growth. And for that reason, even if Microsoft's business grows, its stock price could lag the market or not really grow at the same rate. So that's why, again, I'm not interested in Microsoft stock today. If Microsoft stock came down a lot, then I could definitely be interested in it. Like, if this thing was trading for 20 times cash flows today, then it would be in my portfolio. But the high price that it is selling for today is offsetting future growth, and for that reason, I'm just not really interested. And I have been saying that on my channel for quite some time now. But with all that being said, that's going to wrap up my rant for today, everyone. I hope that you enjoyed this video. If you did, please remember to leave a like on it. And again, if you want to check out my Patreon to get even more content from me, see my portfolio, track all my buys and sells, and get, that Berkshire letter that I'm going through, then seriously consider joining my Patreon. Again, I've been getting great reviews from my Patreon members, and they have been loving it. So make sure to check that out. And if you're new here and you want to stick around and see more content like this, then please consider subscribing to my channel as well. But with all that being said, that is going to wrap up the video for today, everyone. So as always, thank you so much for tuning in. I truly do appreciate it, and I really hope to see you all again in my next video.